5 companies on the docket today, all significance 4 or higher. We've got a brewery going to Africa, a salad chain paying out 600% of earnings, and an ad agency betting the company on generative AI.
Yeah, a lot of strategic pivots happening simultaneously. Let's dig in.
Rockfield, ticker 2910. Net income cratered 70%, but they still raised the dividend by 1 yen. Payout ratio over 200% on consolidated earnings. That's not sustainable?
Right, and the parent-only numbers actually improved. The bleed is entirely overseas. They injected 300 million yen into the China subsidiary while simultaneously writing off 249 million in impairments and liquidating another overseas unit. Conflicting signals.
Meanwhile, they're launching a new salad brand targeting young people and partnering with Kagome. New midterm plan pivots toward daily meal infrastructure. But with ROE at 0.3%, they've got zero room for error.
Asahi Group, ticker 2502. The headline is the $3 billion Diageo East Africa acquisition. That's a massive platform play.
But they also got hit by a cyber attack in September that crippled Japanese ordering systems and tanked Q4. Net income fell 37%. Net debt to EBITDA breached targets at 3.7x.
Despite all that, they doubled share buybacks to 40 million shares and raised the dividend. New DOE target of 4% plus. They also reorganized segments down from 4 to 3 and transitioned to a nominating committee structure.
Ticker 272A. This safety and signage company acquired 2 subsidiaries, Sanken Lease and Chitoshi Bozai Sha, to build an integrated sales and rental model.
Smart move. They're shifting from pure manufacturing towards services. CapEx jumped 46% to buy land in Nagoya and Osaka, expanding geographically. Sales grew 7%, net income up 12%.
They also did a 900 million yen off auction buyback, pushing Treasury stock to nearly 8%, and Fidelity completely exited its 5% stake. Worth watching whether the ESOP becoming top shareholder at 15% is a positive or a concern.
Nadex, ticker 7435. Big turnaround. Net income surged 162% to 659 million yen. Last year's fraud incident is completely gone from the report.
And they exited China entirely, liquidated the Canada subsidiary, and established a new India unit. Meanwhile, they carved out a new smart energy segment focused on EV charging infrastructure.
The interesting part is they cut the dividend despite the profit recovery, normalizing the payout ratio from 110% down to 38%, prioritizing share buybacks and a 267% spike in machinery investment, clearly automating domestically.
Ticker 7095. This ad agency is making a bold bet, replacing the CEO with their AI promotion head to pivot toward generative AI and SNS advertising.
They're recognizing that Gen AI changes search behavior, so listing ads slow down. They acquired Moja and added SNS ads to the lineup, but profits dropped 32% and R&D spending was nearly halved.
The real signal here is the founder's stake sale. MG LLC went from 38% to 30%, and the shares sold matched the buyback exactly. That's an off-market transaction funding an exit. Debt-funded buyback of 2 billion yen. Aggressive capital allocation with declining earnings is a risky combination.
Common thread today. 5 companies all pushing aggressive capital returns, or M&A while earnings are under pressure. The gap between strategic ambition and current profitability is wide.
Exactly. Watch whether Asahi's Africa deal and Rockfield's new midterm plan can actually move margins before the dividend policies break. See you tomorrow.